Hello everyone and welcome to your video update for the 17th of October. So this was a pretty exciting week where we've had the futures Bitcoin ETF launch. Now whether this is necessarily a good or a bad product is something that there's certainly been some debate about. I think the general consensus is that it's probably not the best product of all time. Buying spot Bitcoin is certainly a better deal, and we can discuss a little bit of that shortly. But you know, as part of this process, Bitcoin is now up in the 60,000s, and you know, price action is looking extremely healthy. And really, you know, we're now looking at pushing up towards all-time highs, and I think the probability of it breaking all-time high and then, you know, that being the end of the rally is relatively slim. I do think there's going to be some momentum behind it, and we'll start to see retail interest and all the rest of it start to pick up. So it's an exciting time. But let's start covering some of the what I'm looking for now is actually the headwinds. What could actually trip us up along the way? So what we're going to look at is, as the exuberance and the excitement and all of this starts to build back into the market, what could potentially give us some headwinds? So one is derivatives leverage. Are we going to see a whole bunch of people taking on long contracts and, you know, eventually getting flushed out? Are we going to see spending behavior start to climb? Cyclical distribution, things that we see in previous cycles where long-term holders start to sell? And what is the underlying demand? So just looking at all of these different things and saying, right now that we're in a you know, fairly confirmed bullish trend, what is it that we're looking for that's going to turn this ship around? Now, just a quick note, for those of you who aren't fully aware of how the ETF is structured, it really isn't a great product. And the reason is because of the way that the futures are built into it. It's essentially a basket of futures contracts for Bitcoin on the CME, and they roll, you know, there's some spread of them, 10%, 8% allocation across a whole different series of expiration dates. Now, the reason that this is not necessarily a great product, well, it's not great for the investor. It's great for Wall Street, who's taking their pound of flesh every time somebody steps into the market. Because futures trade at a premium, and Lynn Alden's got a good example here. This is US oil. So this is the actual price trading range of oil, which has, and then there's the USO, which is basically the oil ETF, for it's more or less an equivalent type system. So you can see that the purple line, which is the price of oil, has substantially outperformed this minus 89% of the ETF. So if I understand correctly, and I did see a tweet that I should have saved, but it's gone, you know, it's disappeared somewhere. Someone was basically saying that oil is up something like 85% over the last year to date. And in that same period of time, the ETF for oil is down 35%. So up 85 in the spot, down 35 in the ETF. How does this happen? Now, the general idea behind this is because they have this basket of futures contracts that expire at certain dates, and those futures, when the market is in contango, when the market is relatively bullish, which is also the time that most people are probably going to be buying the ETF, because those futures are traded at a premium, they essentially buy at a premium, and then as the futures and the spot price start to close in on each other, they have to sell those futures at under their value, right? Because they've essentially, the gap between spot and the future is closed. So they then end up selling those futures as they come into expiry and then rebuying at a premium. So there's essentially the ETF is consistently buying Bitcoin at a premium, and then the spot price comes and fills in that gap. So it's not a great product, and it's basically it's called like a rolling basis. Essentially, because of this continuous, whenever the market is in contango, which basically means that the future price is trading higher than the spot price, then unfortunately the investors of these ETFs are really going to have the raw prawn and essentially have their premium eaten up. And you know, we've seen this market before. You know, what we see here is the example in oil. So it isn't really the best product. However, there's a few murmurs going around of Grayscale trying to push to get the GBTC converted, which is just the most sane approach out of all this thing. But we will see how this plays out. But overall, I don't know whether this is going to be the, you know, mega catalyst that everybody's hoping for. It shows that there's maturity. It's certainly putting Bitcoin in a superior position once again. So look, it's not bad news, but it's a classic example of Wall Street taking their cut every time somebody goes into the pie. Right, so let's get into the on-chain stuff and look at some of the data. Okay, so as I noted, we're going to be really looking for headwinds in this particular piece. We're going to be looking for where could potential risks come in that could essentially become, you know, some kind of downdraft, whether that's a buy in the dip opportunity or just otherwise capital preservation. What is it we're looking for that could trigger some kind of downside price action? Now that everybody's looking up only, and now is the time to essentially swap gears and start thinking, okay, this is all good, we can ride this thing higher, but being aware of what could potentially put in some kind of top. So general market structure, I mean, there's very few coins. These UTXOs up here, they've weathered everything that's gone on in the last 6 months, right? 50% down drafts, China banning Bitcoin, Tether FUD, all the FUD, right? The FUD bath of doom. And they have essentially held their coins. Now, granted, it's about 185,000 coins, which is not a great deal, right? So we are more or less in some kind of price discovery. There's very, very little volume up here. We are essentially in price discovery at this point in time. So it's going to be very interesting to see how this plays out. On the institutional front, so the Grayscale Premium is something that I'm going to be paying attention to over the next couple of weeks, because with all this ETF talk and with Grayscale continuing to, push to get GBTC as an actual ETF, essentially Bitcoin's at all-time high, and people can buy BTC right now at a 15% discount via GBTC. Granted, it's not as good as buying spot, but in many instances, 15% is still a fairly substantial premium or a discount, to be locking in. So I'm certainly going to be watching to see what happens on this front, just to see whether we do get that interest start to build back into the market. Purpose ETF is climbing again. So look, again, between these two, these will be interesting ones to watch over the next couple of weeks, just showing whether we're getting that retail interest coming back in. Now, in terms of headwinds of things, this is where we're looking at our derivatives market. So I've got our futures open interest here priced in BTC. Now, the reason for that is that when you plot it versus price, what you're generally seeing is that when the market goes up, the contracts will also go up, right? And we can see here that our percent of crypto margin futures, so these are ones where their Bitcoin is the backing of it, this is now breaking down 47%. So this is a very healthy trend. This is showing that there's more dollars/stable coins backing the margin. This is overall a very positive thing. And we can see that our open interest is climbing, but not a huge deal, right? So in terms of total, we've got, what is it here? 221,000 BTC worth of open interest, which, I mean, that's a huge sum of money. It'd be something like 14 billion or so. So it's a fairly substantial sum. However, note that it's not rapidly climbing like we saw up here at this top, right? This is something that would make me nervous. If you've got this very, very rapid increase, this is just kind of grinding higher, right? It's not that many people opening up lots and lots of futures. Again, it's something that we do need to be aware of. There could be a flush out because it's still a fairly substantial volume overall. Let's actually just plot it in USD just to give it that extra cover the whole bases. But also note that it is positive. So people are taking on more leverage. Our funding rate is in the green. So this is, and again, there's no necessarily high number of funding rate that indicates it's too high. It just kind of is showing the rate of change. And you can see that over the last couple of days, more people are going long. So it's a non-trivial sum. What is this? We're pretty close, 13.7 billion. So we're pretty close in terms of how much volume. I mean, we're pretty much up here at all-time highs, right? All-time high is about 21. So it's a substantial amount. But nevertheless, we are getting closer to the all-time high on futures open interest. And note that we do have climbing funding rate. So just be careful of that. It is a potential risk that we do get a flush out, and that's not going to be the worst thing. Volumes are also relatively up. So this is good because you want volume in there so it can absorb those flush outs, right? You want lots of traders there to absorb it. Now look at this. Options open interest is going nuts. People are buying calls like crazy, right? Expecting that $100,000 rally. So, I mean, this is pretty spectacular. I mean, this is almost at all-time highs. Options volume through the roof. So there's a lot of people speculating on all-time highs and, 100,000s, 200,000s with call options, I suspect. That's the most likely candidate for all of this. So this is certainly an interesting trend. Again, options are a very small part of the leverage, so I'm not exactly expecting them to be essentially, these are people punting on stuff, right? I don't think it's going to be, options are nice. In that you essentially have people who have bought those options. That's their limited risk. Whoever's selling those options does their calculation and they can get wiped out. But the beautiful part about crypto derivatives is that they essentially, once they're cleared, they're cleared. The system just sorts itself out within an hour and we carry on, right? Which is very different to traditional finance where some of these flush outs can reverberate for some time. Now, this is where we start looking a little bit into headwinds. Now, what I normally expect is, and Glassnode actually released a great report by TXMC the other day, last Friday, where he talks about the flow of funds through long-term holders. And generally what we see is as price breaks all-time high, long-term holders start to distribute their coins. Now, that's okay. This is part of the process. This is what happens. And how many coins do they need to distribute to put a top in? Don't really know. But what we're probably going to start seeing is that trend again, where we start seeing these coins coming back into circulation. And we can see here that our exchange flows have essentially dropped to neutral. We've got a little bit of a green print here. And we can see that it's starting to get a couple of inflows as we pull up to all-time high. Why you would sell at all-time high is beyond me, but some people clearly are. On net for the balance, really kind of irrelevant, right? So we're not seeing a trend at the moment, but it's a softening of outflows. So we will see how this plays out over the next couple of weeks, but it's kind of our first sign that there may be a little bit of a slowdown in terms of accumulation up at these prices. I also wouldn't be surprised if we got a bit of a pullback and build up a bit more momentum, spook people before we finally rally higher. We're looking now at volume and activities. This is kind of more on the demand type side. Our number of non-zero balances, note how this is really flatlining. And if you just think about this for a second, right, it's flatlining really through this whole August, September, October rally. And note that through the August, September, October rally, we've seen a softening of people withdrawing. So it's telling us a very similar story. It's not exactly on this rapid climb of people buying more corn and sticking it onto their wallets. It's kind of flat. We're just not seeing that at this point in time. Active addresses is up slightly. Again, it's just all kind of grinding higher. We're certainly not at the point of retail entry. I think retail is coming. These volumes continue to be very impressive. But we're not seeing a huge influx of people at this point in time. So again, it's not necessarily telling us that there's a huge amount of demand necessarily, despite the fact that prices are looking very, very good. So there's a couple of things just to be aware of that may not necessarily be time for launch. That said, if we break the all-time high, it's more likely going to keep running, and then the excitement and the media machine. So we're kind of in this let's just wait and see moment at this point in time. The market looks a little bit like it doesn't quite know which direction it wants to go, but I do believe that when it breaks, it's going to really get some momentum. But I do believe that over the next 6 months, we will be seeing higher prices. If we look at our spent output age bands and our spent volume, we can see it's still really being dominated. This is this $10 million moving around. Still very, very young coins. We're not seeing old coins coming back in. This is distribution. You can see this swelling up of these older coins. That's distribution. This is essentially day-to-day traffic, right? Now, I am actually investigating what is going on in this $10 million because it's clearly what's driving this. So this is our total transfer volume, entity adjusted. That's pretty much it here. So we know that it's about $10 million moving around, $10 million plus. So I'm investigating to find out a little bit more about what this potentially could be. So I'll report back if I find anything. Now, profit and loss. So this is interesting. I mean, naturally, we're going to get fewer people realizing losses because anybody who's got coins above, there's no one left, right? There's basically nobody with coins at a loss at the moment. So it makes sense that all spending behavior is going to be profits realizing. 1.2 billion per day is the median at the moment. We can see that our net realized profit and loss is trending higher. This is excellent. SOPR is continuing to bounce higher. So the market is absorbing sell side. So it's giving us some indication that right now the market is absorbing some $1.2 billion worth of value every single day. And to be fair, it's actually absorbing more than that because price keeps trending higher. But this is essentially the amount of spending behavior that's going on by existing holders. Now, and again, percent entities in profit, percent supply in profit. I mean, what is this? 98%, 98.8%. So basically everyone, right? Everyone's in profit. Everyone's having a great day. When everyone's in profit, the incentive to sell starts to climb. And we're actually going to look at a couple of charts that I've just released to check on chain at the end of this, of which the reserve risk is one of them. And that's an interesting one that captures this incentive to sell. What is the likelihood of somebody actually spending their coins? So now we're looking at who is actually spending, right? So generally we care about older coins because they're showing investors with lower time preferences, more experience in the market. They've seen this before. They understand how this movie plays out. I'm particularly looking at our spent volumes to this bottom row more than anything at the moment because I think the volume is what matters. Very slight uptick, but again, everything's just kind of trending the same. This is distribution. This is distribution. Let's actually look at this on a 1 yearly basis. This is distribution. This is distribution. This is not, right? None of these are telling me that we have huge sums. These are discrete coins being spent, but none of this is telling me we have this kind of significant spending. I do suspect this will probably start to pick up though. There will be older coins that come back to life here. And what we're basically tracking is how many coins is too many, right? To put the top in at some point. This is all supply dynamics. We could probably carry on from those. In terms of ASOL dormancies, this kind of big picture overall age of coins that are moving. Remember that ASOL is on a per transaction basis. Dormancy is on a per unit BTC. Coin days destroyed is just per how much absolute value of coin days being destroyed. So actually just note this. This is what I'm saying. I think we're going to start getting to the point where long-term holders are going to be spending, because see how we've got ASOL ticking higher. We've got dormancy ticking higher, granted from very, very low values. Coin days destroyed standout, right? Starting to actually trend higher, and it's showing up in our binary coin days destroyed. So binary coin days destroyed will print a value of 1 when the current amount of coin days destroyed is greater than the long-term average, and 0 when it's less than. Now I've applied a 7-day moving average to this, or 168 hours. Because what it does is it shows you where you get these trends, right? So when you're getting a value of 1 on the 7-day moving average version, it means that for 7 days in a row, we've had more than average coin days destroyed. So it really does tell you when you've got these trends forming, and also the slowdown, and then this is accumulation. We're starting to get a little bit of spending coming back in. So I'm actually excited. I like using binary coin days destroyed, and I haven't been able to for some time. And we're shortly going to look in check on chain at binary liveliness, which is an interesting metric that I will explain how it all works when we get there. So here we go. Supply held by short-term holders. This has been in a fairly strong downtrend for a long time. Note this little curl, right? That's starting to look, long-term holders starting to curl. Long-term holders are starting to slow down their accumulation. There's probably going to be some spending going on in there. This is all kind of expected behavior as we reach peak hodl. Once we get to the top of the all-time high, people start to spend their coins. So this is what we're looking for in terms of headwind, and what matters is the magnitude of it. So we can also see that our entity adjusted liveliness is also slowing down. So liveliness is the big picture. Is the market hodling or accumulating? Are more coin days being created, meaning that coins are not moving, than are being destroyed from spending? You will get a downtrend when more coin days are being accumulated, and an uptrend when more are being destroyed. So what we're seeing, you can see here's our distribution through the first leg of this market. Then we've moved into an accumulation period, and this flattening out shows that there are coins being spent and moved. So what I actually want to bring back, just because it may seem a little bit confusing, we were talking about the fact that there's not a great deal of older coins moving at the moment up here. Now, what's important to note is that that's because we actually have elevated volume, so you have more coins moving, and thus you can actually have a lot of older coins, because remember that these are in proportion, right? Proportion of total volume that's on the move, or proportion of total UTXOs on the move. Now, when we have higher volume, essentially you can have more coins moving, but still reflect a small proportion. But everything is essentially shifted up. So it's like taking, 2% of 100,000 is going to be different. It's the proportion can be the same, but if you're doing 2% of 1,000,000, you've got more coin days being destroyed, but as a proportion, it's still 2%. Right, so that's really what this is capturing. We're seeing more coin days are being destroyed because the volumes are elevated, and therefore you just literally have more coins that are on the move, even if most of them are young. But that still means you've got 2% of a larger volume of older coins on the move. So that's really what's going on here, and it's enough to slow down these big picture metrics. So this is a very interesting observation. Let's open up this guy full scale, and you can see it here. Note that we've had this downtrend for some time, and now we're getting this curling out, right? This curling out of what's going on in terms of our hodl waves. So our realized cap hodl waves starting to actually slope up from the younger bands. It's showing that there's been some spending over the last couple of weeks. And again, I don't know what's too much to, how many coins it's going to need to put some kind of top in, but it's starting to show that we're getting that very similar behavior to once we break peak hodl. Long-term holder net position change starting to quieten off. Illiquid supply quietening off. And remember, we've talked about this over a couple of weeks, that eventually this softening was going to happen. And it'll be very interesting to see whether people on Twitter are actually sharing these somewhat. They're not bearish, but they're certainly saying that there's distribution. It's certainly a break to the narrative that we've seen, right? And there's no question the accumulation has been there, but we've also rallied from 29,000 to 64,000, and we're starting to see that slow down. So this is a very interesting dynamic, and we'll see how the market sentiment carries all of that. Hash rate's kind of continuing to accumulate and climb, so this is all good. Miners to exchanges up a little bit, right? So that you can see across the board, there's a few different entities who have older coins, miners who are distributing a little bit at this point in time. So interesting observation. Now, this is probably one of my favorite metrics, just because it tells the whole story of Bitcoin. And we've spoken about this before, where you've got the losses during the bear market. These light colors are essentially coins in a loss, and it widens out during the pits of the bear, and then it closes in, squeezes, squeezes, squeezes. Our long-term holders have the maximum supply. This is peak hodl, right? Long-term holders are all in profit, and then they start their distribution into the top, right? We had the opening up of it again. We had 2 phases of this bear. Then we had squeezing in, peak hodl, distribution, right? We are essentially closing in on what is otherwise looking like, and you can actually see this, we've squeezed in all of these, basically everybody's in a profit now, squeezed in. It's exactly the same trend, exactly the same amount of long-term holders in profit, and then we're essentially going to, we're probably going to see this be peak hodl, and long-term holders will start distributing into it. Now, this is going to look something like 2013. Let's just pull this out so we can see it a bit better. Very much like this. You had this squeezing in, rally, bear market, squeezing in, peak hodl, rally. It's actually starting to look quite similar to 2013. So this is just interesting kind of play that's going on. So let's close out on a couple of new metrics that I've rolled out to check on chain. So we're sitting under Bitcoin realized value here. And there's 3 metrics. There's reserve risk, there's realized price to liveliness ratio, which Door Investing recently put out. So this is basically a new metric that I'll explore, and binary liveliness. So I'm actually going to start with reserve risk. So reserve risk is one of, I think it's one of my favorite big time oscillators or long-term oscillators, and that's because it bakes in a lot of human psychology. There's a lot going on that forms this metric. So let me just explain how it works, how it's structured, and what I've got here is essentially all the components that make up how you actually come to develop reserve risk. So it actually all starts with the value of coin days destroyed. So for every coin day that's destroyed, you multiply that coin day, if a coin was a year old and it's spent, that's 365 coin days. 365 times whatever the price is, gives you the value of those coin days destroyed. And that's what this gray line in the background is doing, right? So that is the value of coin days destroyed every day. You can see it's quite noisy and messy and going everywhere. So then what we do is we take the median of that, the median value of coin days destroyed over the, I think it's 30 days. I actually forget what the number is, but it's basically smoothing out all of these, big spikes from an exchange moving a balance and all that kind of stuff. So it's kind of like it's not quite entity adjustment, but it's a fairly crude but effective tool to essentially smooth out that noise. So medians are very good like that. So you've now got the median value of coin days destroyed, right? And you've got this into some kind of pricing model. Now, in the black line, we obviously have our price chart. Now, the black line or our price is the incentive to sell. Now, the value of coin days destroyed is how much was sold. It's kind of showing the propensity of people to sell versus their incentive. Now, note that during tops, we get this closing up where the red line intersects with price. During bear markets, we get this opening up effect, right? Now, the logic behind this is that people are spending up to the current price. They're essentially this closing in, or the connection between this red and this black is essentially showing that people are more likely selling. They're selling more coin days. There's more older coins coming back to the market. The incentive to sell is strong enough that the actual spending is matching with the current incentive. Conversely, during a bear market where accumulation is going on and the smart money are buying coins, you get this opening up between these two. And what that's showing is that there is less spending. People are absorbing the opportunity cost. They could sell, but they're choosing not to. So the opening up, the wider this gap, this is essentially building up people who are buying coins and not selling them. They're choosing not to sell, whereas when they close up, people are choosing to sell. So with that concept, think about every day, whatever the magnitude of this gap is between price and the median value of coin days destroyed, sum all of that across its lifespan, right? It's essentially the cumulative opportunity cost. Every day, every coin that wasn't spent was a conscious decision not to sell. That's how we get this thing called HODL bank. And you can see that it climbs the fastest during the periods where you've got this opening up. During bear markets, it's essentially building up, right? The amount of stored energy, or people who have not sold, they chose not to sell. And likewise, it starts to flatten out as you get this closing up because there's less opportunity cost. People are in fact spending up to that opportunity cost. So the HODL bank is essentially capturing that long-term investor behavior. So then the reserve risk then essentially takes the ratio between HODL bank, which is our kind of macro view, and our price. So So what we're then doing is we're saying, okay, let's weight our price by how much accumulation is going on. So it's saying that the more conviction, the more accumulation that's happening, the lower this oscillator is going to be. And you can see that it actually drags down. See what pulls down in this green zone all the way up to 2017. So all the way up to 2017, which coincidentally was where we broke the all-time high, then it starts to rip. So reserve risk has this beautiful property where it spends a long time in the accumulation zone, weighted by the hodl bank, and then it rips into the top. So as we get this this higher prices and more people spending, it's basically saying now is the time to get out. So it's very, very reflexive in that regard. You can see that almost all of 2019 and 2020 was inside that that green zone. So it really does tell you when you're massively undervalued, and then it will really rip into the top. So that's how you can interpret the reserve risk metric. Now, in a very similar model, so Door Investing recently put this out, so congratulations on your first on-chain metric. This is pretty exciting stuff. Now, liveliness, as we've all spoken about, is this kind of big picture, what is going on with spending and hodling behavior. So when we have a downtrend in liveliness, when liveliness is trending down, it's showing that there's accumulation behavior. When it's trending higher, it means that people are spending, right? So you see it trend higher in a bull, and we trend down during a bear. So liveliness is kind of very similar. It's capturing that when more people are accumulating and hodling, it's going to trend down. Now, what Door's done is he's essentially taken the realized price, which is our cost basis, on-chain cost basis, every single coin valued at the time when it was last spent, and he divides it by liveliness. And because liveliness trades between a value of 0 and 1, what we're essentially capturing here with liveliness is similar to hodl bank. When we've got a strong downtrend, it actually lifts the realized liveliness. I would consider this a fair value model. It's essentially, what do the hodlers believe it's worth? Even though their cost basis is here, what is their hodl behavior telling you? When they're hodling more, the fair value is higher. When they're spending more, you'll see these two close up together, right? Realized price matches the fair value because people are spending, they believe that that is fair value. Now, what's really interesting is note how it essentially caught our lower level here, right? 24,000, it was starting to lift up. Oh, hang on, I've broken that. We've essentially got this, the fair value is trading higher than our realized price, and the reason being there is more accumulation of hodling going on. So we've got more people hodling onto their coins, and therefore you get this gap opening up, which is net bullish, right? At the end of a bull, you've got this closing up, which is telling us that it's relatively bearish. And then during the bear market, when you've got the maximum opportunity period, they start to open up and gap out. And very similar to reserve risk, note how it actually stayed open pretty much until 2017, which is where the reserve risk started to break out and all the spending occurred. So it's this interesting metric. I'm still kind of processing how exactly we can, maybe there's more oscillators that can actually come out of this to map out that gap. Maybe there's a hodl bank equivalent in there somewhere, but this is certainly an interesting metric that I'm paying attention to. And lastly, on that same concept of liveliness, and very similar to binary coin days destroyed, what this is looking at, Bitcoin binary liveliness, it's more or less the same story. So look at 2017, we have this uptrend in this red bar. What this is basically saying is liveliness, the gradient of liveliness, is it going higher or lower? If we're getting a downtrend in liveliness, it means that hodling is going on and you get the gap opening up, right? And I've got two different models here in the blue and the red, but they're essentially, you can see they tell very similar stories. And note how accurately it actually picks these little local tops, right? You can see the spending climbing into these things. So it's actually picking the tops when you get to these relative peaks, and then you get this quietening down, right? Then we enter the bear market. You get capitulation event where a whole bunch of people come back into the market. February was our peak over here. So this is showing spending. This is showing a slowdown of spending. This is showing hodling. So you can really use this very similar to coin days destroyed or binary coin days destroyed. And what we're essentially looking at is this overall trend of is liveliness increasing or decreasing? And we've got two different methods to map it out. So hopefully that's useful. There are a couple of new tools out there. Again, I'm still playing around with the liveliness pricing and just trying to map that out a little bit more, understand exactly how we can use it and how it works. But congrats for Door for getting up that metric. That's pretty exciting stuff. It's always good to get your first metric in the bag. So overall, it's kind of expected behavior. I think I'm very curious to see whether Twitter catches on to this. I'll certainly be writing about it and talking about it more, this overall spending behavior that's coming in. I do believe it's probably going to be something that a lot of people won't like, but you can't go up forever. But nevertheless, if we do get spending and BTC keeps rallying, then that is demand and strength. So that's exactly what you do want to see. So hope you all had a great weekend, and I will catch you in the next report. Cheers.